All right, ladies and gentlemen, I hope you had a wonderful day. It was a lot chiller of a day. There was a bunch of different headlines sprinkled throughout, but it wasn't anything like some of the other days we've seen. And quite frankly, the general vibe, if you see from like 2 weeks ago almost, this was the whole DeepSeek stuff. And then we had, it feels like a weird dream. It was like a whale, a DeepSeek, and AI, and then a mango went to Mexico and Canada. It's very... Point is, man, the market is digesting a lot of the quote-unquote worst fears. We're kind of dodging it, but now that's why I want to talk to you about the bonds, because I'm going to bring this up. It's going to be on the keys, but I think it's very important. You are now back to the level of when we have elected Mr. Donald Trump, give or take. So very interesting here. A couple of things fed into this. Again, the fear from DeepSeek, people rushing to safety, even Japan, and then now throughout the tariffs, and then some of the stuff we got today. I'm actually going to talk a lot more about the economic data. We still got the jobs on Friday. That fed into all of it. So we didn't hear a lot about policy. We still got a lot in store. I mean, it's only been like 2 weeks of the first 100 days, so we have a lot. We're wrapping up the week. I have all of that, the plays, the keys, all the good stuff, baby. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/The Stack Market. We will see you there in the morning, baby. Run it.
Walking to the couch, it's the 2020 election. Live in the hills, but still get a spread. Started with a live, but still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
But right off the bat, like we've kind of been talking about already, the headlines, even after all this tariff stuff, it has been a little bit diluted. Now, I brought this up yesterday, even coming into today. I mean, I know a lot of people are excited, and there's a lot of metrics that could show it, but the market is kind of getting bored of Trump. And this is what I brought up yesterday, even showing you we've gone through like 2 weeks of the worst fears. People are generally feeling okay, but you start to pull out the chart. I mean, we haven't really done much, and we're looking for a move up or down, and that's either going to be based off of good expectations and things not being as bad as we feared, or negative things materialize. So that's kind of where we're at right now, and that's what we need from the markets. This is actually that other data point I want to show you, and this one could be interpreted in many different ways. It just all depends on how you want to look at it. But last time Trump was elected, this is the U.S. equity positioning by asset managers on the futures. Last time in 2016, after the little freak out on the day of, people started positioning pretty rapidly. And now, ever since he's been elected, they've kind of been deleveraging. So people are saying that's a big difference, but then like look at the big difference. 2016, people were kind of under-positioned. There was a lot of front running leading into this. This dotted line is 2 standard deviations of positioning. So even leading into the election, everybody was kind of already overweight. So I thought that was interesting. Even this one, man, I don't know. The shorts, bro, have been obliterated the last 2 years. Even if you go and look, this is from JP Morgan, the SPY and NASDAQ like percentage of shorts compared to the shares outstanding, it's like one of the lowest levels we've seen. Even like 2018, like, I don't know, where my 2018, 2019 bears at, man? A lot of bears, man. I don't know, but that part's not as important. What I was trying to show you with the other part is, quite frankly, like I'm saying, we're waiting for more, but you got to really keep in mind, leading into everything, there's a lot of countries and companies, that's what the trade data showed today, that front ran the election. They were worried about tariffs. Again, we saw Europe, Canada, the pound, all of those moved in advance, even right after November. Even our bonds, we had a lot of back and forth. So we need something more to like really change it, because now, even after these crazy 2 weeks, we've actually gotten a lot of info. We've gotten a lot of freak out. We've gotten a lot of actual resilience in holding up, and nothing with Powell or the data has changed too much. And that's what we got to be looking for. And now that's what leads into the next thing here, because today it wasn't really about policy. Trump did a bill about like transgender in sports and banning some other things. He made a threat towards Iran. He said if Iran tries to clap him, he has already left instructions on how to obliterate them. That's like a loose quote, but I'm close. But the whole point is you didn't really get much economics. Again, there was a lot of things driving the market today, but it was, I think, a little bit more data-wise. We did get random China rumors here and there. There was a headline about Zelensky and the war, or the White House is going to be doing something next week on ending the war, a plan, therefore. They're talking about it. So there's like all these little good news sprinkled, but the real driver, and for the bonds, we're going to talk about TLT, the Treasury refunding announcement in the morning. So this was actually really good news. Not too many people paid attention, and it was more worrisome in like 2023 and when we were worried about banks and debt and all of that, even with the whole inflation thing. But long story short, they said they are going to, for the next few quarters, try not to actually raise any of the refunding and ask for more money. They came in slightly below, and it was actually received as very well. So now, even with Scott Bessent confirmed, that's another thing, part of TLT in the bonds right now, he can actually start doing stuff, and he has already been talking about it. So that was really good for the bonds. That gave you a lift off of the morning, and then the ISM data came in weaker, overall weaker on prices, employment, almost every metric. And again, bad data is borderline good for the bonds, and it wasn't bad data, it just wasn't as hot. Remember, people are worried about tariffs, things going wrong. If the economy's too hot, then we have to worry about inflation. But all of that front running that you saw in like the GDP data, and then looking at this data, it was actually really good for the bonds. That's why they are now getting back to that Trump level. And this is what I'm saying here. This is just a good sign broadly, whether or not you're like, oh, rates or bonds should be lower. At the end of the day, you got now bonds chilling out back to the November 7th level, and the market's still advancing after everything. So I think it's just generally a good, stable sign when it's all said and done. Even with the dollar and gold and some of these other crazy stuffs, it's better than not that you're getting bond stability, even with asset prices still holding up. So I take that as a win overall, and that's why now moving forward, we'll see what the jobs give us on Friday, and there is going to be an AI summit next week. Maybe that brings in some of the new juice. Again, we are going to get data tomorrow. I think Friday is more important. Jobless claims, we'll see. There'll even be like unit labor costs that might stoke things if people are excited about the bonds, or maybe we wake up to some good policy, and then you're going to just get random China, EU, Bitcoin headlines too, but I would only wait to react to those once you get to the hearings. But China, EU tariffs, they're still kind of on ice. It's either going to be this sleeping giant or this sleeping dud and play out how it did with like Mexico and Canada. So we'll see where it leads us. But other than that, if it's not about policy and we're not getting the headlines or the headlines related to the economy, we see if the market could calm down on its fears with all of the craziness. We either get the economic data or now wait for the next set of news to add the craziness to the 100 days. So, Chad, I hope you're ready for all of it. But now, let us get into the plays. So, right off the bat, I got the first one, TLT. I would be watching this and watching the bonds. Like I'm saying, all of this stuff, there's a general theme going on. I even have another cool chart to show you, but even at the very least, if the bonds in the short term calm down, watch the Russell. The Russell is also faded since Trump. If the bonds go, we saw a lot of small caps move. Maybe this wakes up, or at the very least, maybe in the next week or two, if bonds really could calm down, nothing bad happens even on the non-farms, maybe watch for the Russell to at the very least outperform the S&P 500. So that's something to keep your eye out. That could give you a lot of different play ideas. But now the opportunity in TLT, it's back to the election zone. It was much lower just a couple weeks ago, but you saw how everybody has been freaking out. And again, these last even 2 weeks, DeepSeek and all that, it's been crazy. So bonds are doing decent now. It's either they're going to start rallying after this, but what you're going to need is the market to take Bessent seriously and start to view some of the policy actions so far and be like, okay, maybe the deficit isn't going to go crazy, or maybe some of the inflationary factors aren't going to materialize. That's going to be the rip for bonds. Otherwise, there still might be pressure. Maybe people are calming down a little bit after the few weeks, but if data gets bad again and all that, yeah, you might go up here just like we kind of did with the sell the rip. This gap up is way better. You're probably more so here than you are here compared to the last time people calmed down and then quickly the media made them freak out. So we'll see. But at the end of the day, you got to be prepared for both options. But something you should be looking at, and just quite frankly, people are calming down a little bit. That's what, again, after all this fear, getting this resilience, as long as nothing drastically changes negatively, you do have people calming down. And the more and more data you get that doesn't go crazy, the more and more good things happen rather than worse things. I mean, again, you're already near highs. People are going to feel good about that. Now, I've been saying this for a while, but it doesn't matter as long, I mean, generally you need consensus, right? And people have to agree, but a couple of banks now are saying the same thing. And I was telling you guys this morning, I was like, just do the math. Look at the tariffs, look at the amounts. You know, if you really want to warrant a freak out, it'll be in the numbers in a very odd way, especially if the market really gets back to responding to that than Politico. Oh, no. But anyways, point is, Goldman did the calculations, and, like, there's a lot of math behind it, and they just factored in pretty much 1 percentage point of increase in the PCE, depending on the tariffs, and then what it leads to production costs if we get anything offset. Long story short, this is Goldman, and they're just saying that even like the max initial burst of the Trump tariffs, they would expect on the 12-month, and even how long it would take to implement, 0.46% on the PCE, a one-time increase, and then we go from there. Obviously, this could be wrong, but all I'm just trying to tell you is now people are calming down. This is different than, I mean, again, the last few weeks, people have just been fearful of the boogeyman. It didn't matter what anybody said or what data was there. Like I was saying, even with the piece, it's just weird. The Fed got more worried with zero evidence rather than things materializing. So if banks start to get on this, like I'm saying, even JP Morgan, a couple people are noticing things. We'll see where this leads us, but you should probably keep your eyes on the bonds. I still have those March plays. They got whacked. Again, we made some of the other ones free, but those should still be in play. But this could, if you want to double dip or not, that's going to be up to you. But the point is, this macro environment, the bonds really calm down or not here. This is going to lead to some opportunities, or just going to play out how it did in November. So I hope you're ready. But that is play number one. And don't forget about the Russell. And then play number two, man, gold. This thing's insane. I've been like saying it in passing, but I finally figured it out, or at least here's a Wall Street bank narrative. They're saying it's because of tariffs. I don't know how I feel about this. Kind of makes sense. I'll show you the one thing that I care about. But literally they're saying this is part of tariff fear leading to a physical shortage. That's why people are moving it around to America here and there. And they're worried, even though like gold has never been targeted as part of tariffs. Like gold and silver, like bullion, it doesn't really get targeted. They're worried that a blanket or aggressive tariff would lead to that. I don't know how I feel about that, but fact of the matter is this is the objective thing that is occurring right now in the gold market. Compared to the last couple of years here, I mean, 6 years or so, the borrowing cost for gold is rocketing up, and that is odd. Again, even in like 2021, 2022, didn't you guys try to squeeze silver? Yeah, so you're not getting the Reddit post, but something's going on there. I mean, some people are calling this worst case scenario or like the pain trade, but gold has been wild, so I would keep an eye out for it. Again, we've talked about it a lot, and like I said, once I figure it out more, I'll be more confident. I think I'm getting closer, but I would just keep your eye out for it. And this is like I'm saying, this doesn't happen too often. You might want to pay attention to it, maybe both sides. So keep your eyes out for that. I wanted to put you on to that info. And then finally, play number 3, tie this into TLT and everything else. I'm not saying buy these for the long term, REITs, but if you want to be mad early, this would be your opportunity. The yields are still reflecting the risk, okay? I still think bonds really need to stabilize, and we need a lot more. Again, you need market really convinced the deficit, really confident, invest it. I'm fine taking a lower yield and still buying, a multi-year dip on the REITs, But at the end of the day, if you really are feeling that, and if we do get the bonds, and this is that moment where they calm down, or at the very least, market really cools down on the whole tariff deficit thing, like I'm saying, this might be that moment for the REITs. But I'm going to wait for more stability. But even in the short term, if we do get a couple days or maybe a week of popping on bonds, some REITs are going to feel that for a little bit, and then it's all going to fade. So keep your eyes out for it. But other than that, I think my daily call, or I held it for the next week. That one got washed and then came up. We had a good daily play, but then I did it way too far out the money. It only went up 50% at one point. I lost $3 today, flipping back and forth. But if you got in the money on that, you probably hit it. But again, not really any crazy news pops. I did make a play on Rigetti. because there was news that Intel and Japan are working on a supercomputer, and Intel went up on that, and there's even rumors of a new CEO that's not me, which is odd, but we'll see if anything materializes. Again, they already had their earnings, and then what was the other one? Yeah, I played ARM. I did ARM. I spent like $100 or $120, $60 both ways. I thought this one was going to be one of the movers, but no, underwhelming. I don't know if Qualcomm, they were pricing in 7. They were up 7, then they moved down 3. Again, just a lot of these were underwhelming. Ford warned on tariffs, but I do think they were even all within the range. So we'll see the follow-up, but again, we may either need to wait to break out of the range, or maybe we turn our attention to the data and the bonds. We will find out shortly, but Chad, that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. You need to go watch the Philo at night, bro. Be yourself. Chad! Oh, man. Keep it up. Either side. Don't give in to the lows. If you're at the highs, you better take advantage of your momentum, my friends. And that long term will heal your soul. I don't know if they... Stop it, bro. Stop. Drink that water. Stay hydrated, healthy. All that good stuff, baby. I'll see you in the morning. And Horna.